financial independence is nothing but freedom of thought, freedom of action. And I think that's invaluable. If you have to constantly work in your life to be able to live, then you'll have all sorts of restrictions on your life. When to wake up, when to sleep, and I think one should aim for financial independence. Everyone should aim for that.
This is Siddharth Alwalia. Welcome to the 100x Entrepreneur Podcast. This episode is brought to you by Prime Venture Partners, an early stage VC fund led by Amit Somani, Shripati Acharya, and Sanjay Swami. Prime is often the first institutional investor in category creating tech startups in fintech, SaaS, healthcare, and education such as EasyTap, MyGate, and SignUp. To know more about Prime, visit primevp.in. Today, I have with me Paras Chopra, founder and chairman of Wingify, the company behind the market-leading A/B testing tool, Visual Website Optimizer. VMO, as it's usually called, has changed the landscape of customer experience on apps and websites. Listed twice in Forbes 30 under 30 list, Paras is most known for his blog, Inverted Passion, and for obviously his Twitter handle, where he publishes his notes on mental models, thoughts on topics ranging from economics to AI to blockchain to life sciences. Welcome, Paras, to the podcast.
Thank you, Siddharth. Thanks for having me.
Paras, so I want to structure this conversation, is mostly on wealth creation. So I follow also, Charlie Munger's advice, invert, always invert. So
Yeah.
also title, if you have to give this conversation, how not to be poor.
That's a great title.
So can you take us through your process of wealth creation in the last 10 years?
Sure. So, I think it may help to first define wealth and what poverty means. To me, wealth is the stuff you want, the stuff that's useful in life. So it's related but different than money. Money is, numbers in your bank. But true wealth is, I think true wealth is indistinguishable from a good life. So in that context, I'll talk about the wealth creation. And I think to a certain extent, when it comes to wealth, people obviously mean it as financial wealth. And in that regard, I feel talking about financial independence and what that means is the most important story. So I'll take back my own journey from that context. I think my first brush with making money was when I was 12 or 13 years old. So I would make a lot of software in Visual Basic, C++, put them online. And these were early internet days. And someone would download my software. And one time I got an email to modify that software, and someone wanted to pay me $100 to modify that software. And just a few changes I did, and the person sent $100 via Western Union. You had to go to a post office to collect that money, and I went there with my mother, and got that first bundle of money. I think it was 5,000 rupees or so, and it felt surreal. Because as a 13-year-old, tweaking software, writing code, and converting that into some real money, that seems really magical. uh, and from there on, somehow I felt that doing something that I love, which is coding and programming, and trying to make money off it is how sort of I want to imagine my own future. So I went into startups as a consequence of this thought, and I read books by Paul Graham, and Founders at Work book was an absolute gem. It inspired me and opened my mind by reading interviews from PayPal founders, Yahoo founders, Google founders, and seeing them create such an big amount of wealth for themselves, and even for their communities, by just having a laptop and software. I think that was what was fascinating to me. How can you convert your ideas into so much of money? And so in my college, I tried doing a number of startups. I just knew that startups is what I want to do. And but for me, I think it was more of an intellectual challenge. I think it was an intellectual challenge first, and desire to create money second. An intellectual challenge because this seemed, money creation is obviously not a trivial thing. It requires a non-trivial amount of commitment, and intellect and passion and so on and so forth. So this was like a mystery for me. How can you create a lot of money without sort of being, Birla or a Tata or a Reliance? And within that journey, I kept trying different startups. In my college, I did 3 startups. They didn't work out, but I was reflecting and learning from my failures. And Wingify was my fourth attempt at doing something. And um I remember when I was doing Wingify, I was, because this was my fourth and fifth attempt by this point of time, my default assumption was that whatever I was doing was not going to work out. So that was the default assumption with Wingify as well. But this time, I think I felt a very different kind of response from users, and I clearly remember feeling, in my gut that I will be able to make equivalent amount of money as my salary. So I worked for about a year after graduating, and that was my goal. If you talk about a wealth creation journey, that was the first biggest milestone. Could I make 50,000 rupees, which was my salary, from my own project Wingify, as someone else was paying me when I was doing a job. So when that happened, I was just very very happy, and it rolled from there. It Various different milestones happened, and I think the joy again was in learning what is it to be an entrepreneur, what is to be a leader, what is to be a manager. And money frankly had been always a secondary consequence. And the reason I say so is because, if money was the primary motivator, I imagine I would have gone ahead and we would have raised some funding, but we didn't. You know, we had more amount of money coming in than we knew what to do with it. And I think that's a measure of wealth in, I think, both personal and professional context. Uh, I think it's not the amount of money, but it's amount of money relative to your needs. And as a bootstrap company where we were like 5 or 6 people initially, all very young people, all living with their parents, having no rent to pay, and literally just having a laptop as an investment and server as an investment, and charging dollars for our software. I think there was always this differential that kept on increasing, and that just kept on rolling our revenue, our personal wealth, and the profit of the company.
And during that journey, when you give thought to money and how to manage it, what were the subsequent actions that led to, let's say, if I'm getting this money from Wingify as a founder, I'll invest this in these many assets, right? So my question is the thought process and those
Right.
assets which you kept on building.
Yeah. So I think it was 2 or 3 parallel threads. I think the first priority was always that business growth comes first. So always sort of I made sure that not taking out money from the company that money can utilize profitably. There's always been the case that we've first taken out and reserved the amount of money revenue that's coming in for making sure it pumps back into the company. I think as an entrepreneur you have to realize that the company that you're working on is the biggest contributor to your future net worth, because whatever else you invest in, maybe you invest in equity, you may invest in real estate, you don't have as much control on the value appreciation of those assets as you have for your own company. So Wingify is absolutely my number one factor in wealth creation, and that's why that would always take a precedence in terms of its growth of value, and correspondingly factors into value, which is revenue and profit. So that's number one priority. But after that, I think to a certain extent as an entrepreneur, I've seen some entrepreneurs go to extremes where they absolutely overinvest. Maybe they take loans and they just are crazy about investing into business. And I think you can take that to extreme, and I've seen people who've gone into debt because of their company. So another, I think another important factor is, as an entrepreneur, you can only function effectively, I think, if you are feeling safe. And financial independence, financial safety, that net blanket is, I think, quite important for an entrepreneur to feel safe. I think a lot of entrepreneurs could attach their egos with the company, and that's totally, I think, a wrong thing to do. If something is fundamentally broken, if you've not figured out product market fit, if you're, say, customer acquisition channels are unprofitable, just throwing money at it is wasting money. So you have to be like a thinking like an investor first. If it makes sense to invest in the company, invest it if it's profitable. But if it's not, I think you have to take care of your financial independence. So one factor for me was definitely making sure I have enough money to not worry psychologically about my safety, my family's safety. And that is the pool of money I tried to invest, and made lots of mistakes in terms of assets, in terms of risk, and so on. And I'm happy to go into that detail if you're interested in that.
Then my next question is, right, at what point in Wingify, right, currently Wingify ARR would be $25 million, right? But at
Yeah, in that range.
what point in the journey you felt that right now the company has hit a point that I feel financially independent?
Right. um I think this comes from, I mean, this is personal to different people. Wherein, I mean, the way I think about this is, uh, you have, I mean, there's lots of formulas on the web, but the way I think about it, your corpus should be enough that tomorrow, if you have no income source at all, you are able to live off the interest of your portfolio. I think that's everyone desires, and the way to calculate that is to see your annual expenses. I think your corpus should be enough that, drawing say 2 or 3 or 4% from a corpus, which is the rate that they call as, everlasting corpus. If you're only drawing 2 to 3% from a corpus, you can last your entire lifetime from that corpus. So if your monthly expenses are 100, and you are putting a target of, say 3%, so I think that 3000 as a, uh, I'm not sure if I'm doing the math right, but the whatever your expenses are, they should be like 3 to 4% of that corpus. So that's a target, and once I achieved that target, uh, I felt, financially independent. But again, the key point is that, the annual expenses is the critical ingredient, and everyone can be financially independent and feel financially secure if their annual expenses are in check, or if they don't feel like they need a very big bungalow and a Ferrari and so on. If that's a need, I think you'll never be financially secure and independent.
You are right. So even I have read the same. That if you have if you're spending, let's say, 2.5 rupees in all your expenses
Yeah.
in a year, then you need to have, if you have 100 rupees in your assets,
Yeah.
then at that point in time you are financially independent.
Yeah. Yeah. That's exactly what I'm saying.
And then let's come to the part where you are able to draw good money from the company, and now you were able to make mistakes. So if you can share, what were those mistakes, what were your learnings on investment?
Yeah, I think the number one mistake was real estate investing in that, and I think that comes from our parents' generations. I mean, they have seen such a rapid rise of appreciation in real estate. So, I mean, there's lots of myths associated with it, where it's safe, it always grows, and it's I know what, but I do feel, and it wasn't like a major sort of part of like my portfolio, but I still regret it, um not because the money is sort of like, stuck there, but because there is this aspect of maintenance with it. If it's empty, you have to find a tenant, and if not, you have to just keep paying maintenance bills and so on and so forth. I think I like to see my sort of financial assets work for me even when I'm sleeping. I think that should be the whole point of having financial assets. But if you have to work for your financial assets, I think it's the reverse way. So I don't like to sort of be in constant, it's not even worry, it's just that, you, if for example, if you're investing in mutual fund, everything is just so transparent. You can see, they cut taxes automatically, everything is sort of done for you. But if you own like an office or a home as an investment, then good amount of your time could go into, maintaining, talking to tenants, finding them, doing property bills. So I absolutely feel it's a mistake. Also, the data shows that an index fund, like a Nifty, would beat property, historically also. Even if you see right from our parents age also, if you had invested in stocks versus property, it would beat. And even Warren Buffett calls he even says his mistakes is buying the house he lives in. He would rather prefer to rent, and I feel the same way. So real estate is absolutely a mistake in my point of view. And I think I think actually chasing the safe assets early on, where I see many of my friends just keep their money in FDs, is a big mistake. It's a mistake because they don't believe in the long term sort of proof that equity markets I mean, if you are a 25-year-old, you're absolutely doing a mistake unless you have a majority of your money in equities, because power of compounding is so that by the time you retire, the difference between keeping money in FDs where the tax rate is higher and interest rate is lower versus equities is just substantial. I feel investing that 1 hour in reading and digesting why equities is a good bet would be the best investment anyone can make in their life. But yet people don't do it. I don't know why they keep their money lying idle in banks or FDs without having a plan. So the way I structure my thought process around asset allocation is that one, I think health insurance and term insurance is necessary. People sometimes keep their money for health emergencies, which is fine, but it's the right way to address it is by taking like good insurances for that. Once that's done, the amount of debt, that by debt I mean fixed deposits or even mutual funds for debts and so on and so forth, or liquid funds, the amount of debt in portfolio should be a function of your annual expenses again. So I see some people do 20% equity, 80% debt. I think that's a wrong way to think about it. Debt's only function is to help you if somehow a crisis happens and you want very liquid low risk money. And usually having like 1 or 2 years of your monthly expenses should be good enough. But everything else in my opinion should be just equities, and that too mostly index funds. I mean, this simple portfolio has served well for me. And no gold or very less gold, no real estate, all these things, it just feels they come from a place where not a deep thought and analysis has gone.
So today, I believe you would be like 34, 35, Paras?
Yeah, I'll be turning 34.
Yeah. So at what age you realize, right, that equity is your asset class? Because as you said, right, not a lot of 25-year-old, because of what we inherit as a thought process from our parents. FDs
Yeah.
are safe, house are safe.
Yeah,
uh,
yeah. I think it has been a progressive journey for me. I empathize with people who don't do it, but I say it not to point out, that uh, I mean, not to say that they should know better, but to share, what my experience has been, and why. And it's not just even blindly invest in stock funds. I mean, I have written threads where I've explained why this makes sense. So I just imagine if someone had explained to me in those terms, I would have absolutely jumped and put almost all 100% of 90% of my money into equities. So it has been a sort of slow journey for me. Uh, but I don't recall ever there was a point where I was less than like 70 or 80% equities. I still went ahead and did mistakes in real estate, but it's always been majority equities.
and did you also dabble like with new asset class like crypto or investing in startups in personal capacity, right? When you had like little amount of that wealth which you want to dabble with.
Yeah, so crypto is not something I'm very interested in. I mean, I'm interested in from like a cultural phenomena and the technical details point of view, but I don't understand it as an investment point of view. I mean, it to me is a speculative instrument, which is fine if people want to speculate. But I don't necessarily derive my joy from tracking what's happening to speculative assets. I mean, I mean, to me, life which is obsessed around portfolio number is a waste. I mean, portfolio number should be in service of leading a good life. But I do see if you have a substantial portion of crypto, I mean, in my friends group and others, they may or may not have it, but a lot of discussion does around happen around it. And if a substantial portion is invested in crypto that goes up 50 or 60% on easily some weeks, It's not something as a way of like a peaceful, good, tranquil life. So I avoid it completely. I have invested in a few startups and I've started investing in it more actively. But again, it's not been very speculative. I've been very, very choosy, and I'm more interested in investing in startups where I really believe in the technology or the story rather than from a purely financial point of view. So it's sort of a way for me to understand what interesting problems people are solving for.
And interesting thing is that you have been consistent with your practice. So it's not that hit a jackpot. So what I have learned, right, interacting with many people is people think, right, getting financially independent is like hitting a jackpot, because we have been brought up in an environment where lotteries were there. So people think of investing as a picking up lotteries, or investing as fair weather investing. When cryptos are going up, invest in crypto. When stocks are going up, uh,
Yeah, yeah.
uh, invest in stocks. What's your thought on that? Do you like really hit jackpot, or is it just a consistent journey to financial
Uh,
independence?
I mean, it's been. I think investing should be the most boring thing that you should be doing if you're trying to derive joy from investing. I think that is speculation, and we should call it speculation. I mean, it's okay to speculate, but don't call it investing. Um, and I mean, one invests not for tomorrow, or not for the next year, or not even for this decade. I think one invests for, say, your 30, 40, 50 years, where if I mean, if you need to sort of tap into that portfolio ever, that is when it's useful. So in that sense, whenever you're investing looking for what's hot today, I don't think that sort of makes sense. If you're investing for with a timeline of decades, then going with what has worked for decades is a much better bet than what's working yesterday, or what's working this year. So I keep following some very dumb principles like index funds, blindly and consistently, and so far they've served me well. And I don't sort of get engulfed in the hot stock or the crypto or whatever else that's going on. It's just not me.
So for you, it's mostly Indian funds or US funds?
It's both, a mix of both. I do think one has to. I mean, diversification is the only free lunch in finance, and if you're not diversifying, you are taking more volatility, more risk than it's necessary. And having everything tied to India is fine. India is a fast-growing country, so majority is India. But if there is ever a case where there's India has some sort of an hyperinflation or a faster inflation or some other issue, I think it would pay to have this diversification in US markets or international markets. And I think there are funds in India that allow you to take US exposure. So you don't have to, again, even open any bank account. You can just Google, I think, US mutual funds or US stock mutual funds, and they are available in India.
And Parth, if you have to advise any like 25-year-old, right, on savings rate, like savings rate is not really talked about, right? People again think that investing is that you hit a lot of sum of money and then you park it anywhere else. What has your been journey, right? Did you focus on savings rate at all? And what percentage, let's say if anybody is earning X a month, right? What percent you should say that if one aims to retire at 40, what X percentage a month should one start parking in uh,
Yeah.
equities?
Yeah. So I don't look at it as a percentage. I think one should look at their monthly investment target, and if possible, and to whatever extent possible, adjust their expenses around it. I think a lot of people do it the reverse way. They spend whatever they can and invest whatever that's left. But I feel it should be other way around, because there's no limit to expenses. The world is out there to get your money, and if you allow the world to do it, you can be out of your salary each and every single month. So much better is to, I think, use one of these calculators online and see what's your monthly investment target should be, if you want to have an X amount of corpus by year 40 or 50 or whatever, and keep that target for saving. And if you need to shift to a smaller house, maybe get like a not so fancy car, or order less online and cook more. uh, I think that's a good investment that you can make. And frankly, I mean, if ultimately it's if we go to the deepest level in terms of happiness, we all know, happiness doesn't necessarily change. It just comes back to the same fixed point. So would you rather be equally happy and have a more amount in your portfolio versus have less amount of money in your portfolio and just get this intermittent kicks by spending a lot more? So um, so yeah, I mean, absolutely, spending wisely is the biggest one of the biggest sort of factors into whether you can retire independently. I think it also helps once you keep increasing your lifestyle, you keep adjusting there, and you'll certainly find, it's more difficult to get back to a lifestyle if ever, your income source gets impacted.
Yeah, and but then the argument of the people is, why am I increasing my earning if I can't change my lifestyle?
I mean, you're increasing your earning to get to a point where you can, say fuck you to things that you don't want to do. I mean, that financial independence is nothing but freedom of thought, freedom of action. And I think that's invaluable. If you have to constantly work in your life to be able to live, then you'll have all sorts of restrictions on your life, when to wake up, when to sleep. And I think one should aim for financial independence. Everyone should aim for that, because that comes with so many benefits in terms of freedom of thought, freedom of action. uh, I mean, you can always increase your expenses and make your lifestyle better after you've done it to a little bit. But I don't know, I mean, some people might be okay to signing off or not being financially independent, working hard their entire life. It doesn't sort of, I have hard time sort of understanding that fact.
And Paras, if you can share, what are the other money mistakes beside real estate that you did?
Hmm. Um, I think I mean, financial advisors early on have, they keep pushing really complex instruments that are hard to understand. I remember early on there were some things called ULIPs, where it was some mixture of insurance and equity link. And I've come to sort of a realization: the more complex something sounds, the riskier it is. And so I've stayed away from those. I'm I mean, I'm not sure what you'll call as a mistake. Maybe not buying Bitcoin when it was $2 was a mistake. I mean, I recall I went back in my chats and saw that I knew it was going to sort of grow big, but I never sort of acted upon it. So I think my inaction, you can call it as a mistake, wherein I was I mean, I was averse to certain ideas uh, in terms of, they being part of financial assets, that I didn't invest. So I'm not very active in financial investing. I'm pretty sure, sorry, angel investing. I'm pretty sure if I was more active, I could have made more money. So, and similarly, crypto and so many other things. But I've kept things simple, and according to, sort of my needs, I think they worked out.
But let's categorize the mistakes as action that if you now go back in time, you could change it.
Right. Yeah. I mean, in retrospect,
That's
everyone is a
in action.
billionaire,
That's
right?
in action, right? So I'm talking about action like buying a house. So if you could go back in time, so you would have not bought that house.
No, absolutely, I wouldn't.
So any other
Yeah.
kind of,
I would have not also sort of put money into debt funds. Early on, I think I had a portion of debt funds. I think financial advisors talk about that it should be 50-50 or some equity debt. I would not have. I would have gone 100% equity right from, sort of day one. And I think these two broadly, and never went into things like gold or other sort of instruments. And uh, and I think one time I also remember I had made like a foolish mistake of just going ahead and buying five random stocks. I think I was just going by mutual funds, and one time I felt, everyone talks about stocks, let me buy stocks. And my level of research was that people will always watch movies, so let's buy PVR stock. And people will always have steel, so let's buy Tata Steel. I mean, it was really dumb half an hour binge of buying a few stocks. I bought it and I forgot about it. And I remember after 3 years, out of five stocks, two had crashed to almost zero, and three had really increased in value. So net, I had made some 10% return on five absolutely random choices. So I don't know whether I'll call it a mistake or not, but obviously the level of research I had put in was close to zero. So buying stocks and having that amount of risk without investing time, and I think in retrospect that taught me to stay away from individual stocks. So I don't invest in any stock per se. I go with index funds because I feel it's hard for me as an individual to beat uh, mutual fund managers who've made their careers in 20 years, 25 years, and spend all their time researching in the companies. And obviously it's hard for me to beat the market, which is the index fund itself. And I think I've tried researching into these ML based trading. So I read how Renaissance Technology and a couple of other hedge funds use a lot of AI and ML techniques. But again, my conclusion was that uh, unless you're committed to doing it full time and doing it professionally, almost always you are setting up for giving your money to more professional people than you. I think I've realized that I'm either it's full time that you're doing, or just stay away and be with very safe and passive equity indexes.
So, Paras, in your journey, right, what was the point that you realized, right, that index funds compounding 15 to 20% max year on year is the right instrument for you? Because they don't they're not something, they're passive, right, as you said, and there's no joy of investing in index funds. It's just that you are playing X percentage of money every month into
Yeah.
back into the same instrument, right? What percent you ride, right? That if you ride it over a long period of time, it's going to work.
Yeah. So I think if you read recent Warren Buffett's annual letters, he says even he has a hard time beating S&P index. And all so I've done like reading, and this just doesn't come from an idle belief. Almost all academic research says that actively managed funds return even worse than index funds. And even if when it comes to uh, VC funds, I think the median VC funds returns worse than index funds. That's what research has showed. So I think after I digested why it's hard to beat the market, it's not that that if there was like a good logic to why an opportunity is mispriced, then it makes sense. But with more and more, I mean, as the time goes on, there's less and less opportunities that are mispriced, where you have an edge over others. So if we assume that markets are more or less semi-efficient, then I think this makes sense to me. I mean, and I prefer just having that money thrown into a bin and forgetting about it, and opening that bin after 30 years and seeing it grow and compound. I'm not the kind of person who wants to really see whether that stock went up in the next 7 days or so. I don't feel it's a good investment of my time.
And during your journey, Paras, right, any internal metric that you use to measure, right? That one you mentioned one during our podcast, that if it makes you unpeaceful, stay away from it,
Yeah.
right? And
Yeah.
that thing you followed with Bitcoin, so you're not worried whether it's going up 50% or down 50% in a
Yeah.
matter of seconds, right? Any other internal metric while which you focus while managing money?
It has to it shouldn't require me to work. That's again, like real estate is off the list because it requires me to work. So I want it as passive as possible, requiring as less work for me. And second, like you said, i I don't like to speculate unless or until I have some special knowledge or an insight, and or an edge. Otherwise, it's just idle speculation, and I don't see how that can work in my favor except for luck. So I don't want to rely on anything working out for me. being lucky in something. I want the logic of an investment to make sense. And um, and I don't have like an IRR target per se. I think that's something beyond anyone's handle. It really depends on a large level how economies are growing, how innovation is happening, and so on and so forth. But as long as I think my portfolio is growing faster than inflation, uh, you can call that as the base level metric that I'm tracking, whether my money is growing faster than inflation. Because if it's not, then it's truly declining in purchasing power.
And Paras, can you recommend any resources, books that you read or you follow currently, the blogs on managing money and managing building wealth?
I've not read it, but people tell me this book called Psychology of Money is a good book. Um, and I am a fan of Thought Process by Warren Buffett and Charlie Munger. So I think Charlie Munger's Almanac is a good book to follow, and Warren Buffett's annual letters an absolutely treasure to read. And I would advise your readers to go and simply Google index funds versus active mutual funds and read some articles around it. Why it is so hard to beat these passive index funds. And I think the financial independence subreddit on Reddit is also a good resource. They do talk about a lot of things that would be relevant to young people who are starting their investment journey.
And Paras, now when you are financially independent, what's your daily routine that you follow? Now, you are also like not the chairman of Wingify. Earlier, you were active CEO, right? And you took a step back and did that. What was the reason for that? And not what's the routine you follow in your day?
So reason for that was I think both Spurs and I want to play by our strengths, and I realize over a period of time my strengths are in figuring out and building something new. So that 0 to 1 phase is something I really enjoy, and B, I think I'm good at that, having done that a couple of times within Wingify with different products. Uh, and uh, and that's the whole point, and that's what I focus on right now. So I'm constantly focused on, the innovation part, and where Wingify could enter into, say, new businesses, or what new products can Wingify create. So I really enjoy seeing that, blank slate, and thinking what Wingify could sort of fill in that blank slate. And that's how my days go, where I'm reading and researching and thinking, partly from a curiosity point of view, but partly from an action point of view also. And um That's mostly about it. So focusing on what new to do, and reading and researching, so you can really think of sort of like an internal entrepreneur in residence at Wingify, which I really am.
And you moved away from Delhi to Pune.
Yeah,
Was there
I did.
what was the reason behind that?
I mean, I'd grown up in Delhi. I've all my life was spent in Delhi, and I felt, I think it was the right time to sort of explore living by myself, living, me and my wife to live by myself. And also Pune, was a wonderful city when we visited. It's great weather, less polluted, and more chilled out. So purely from a point of view of exploring something new, is decided, that moving away from Delhi and spending time outside of Delhi would be a good idea.
One thing which is evident in across all your writings, and now you're publishing a book, right, which is mental model for entrepreneurs,
Right.
right? And you share a chapter on that. So it looks that most of your days are spent in curiosity from your Twitter
Yeah,
and
that's
what
right.
you write and in inverted passion. So is there a like a separate reading time that you have, like 2 3 hours a day, which you
So
focus
in the
on that?
morning, so the way my sort of I mean, I don't take meetings before 4 p.m. or 5 p.m. So I think I do follow what you can call as deep work principle, where you have a block of time slotted just for yourself. So in the morning, when I'm most energetic, I feel most productive, I slot that time to read, think, and write. So from say 10 or 11 a.m. to 3 or 4 p.m. is my own time. And after that, if they're meeting discussions or email or Slack, that's when I go about and check it. So the best time, the best sort of slot of my day is kept to exploring my curiosity.
And is there a time that you, at the like 7 p.m. or 8 p.m. that you put a hard stop? You will not take any meetings. Uh,
Yeah, usually I don't take meetings after like 7 p.m. or so, or on weekends. I think I kind of like that way, wherein and I have seen that. I mean, I think uh, one of the biggest productivity boosters that Google calendars can do is to reduce their default meeting time by 1 hour to 30 minutes. And my default meeting time is 20 minutes, and I felt whatever can be discussed in 1 hour can be discussed in 20 minutes. So I don't think being productive, frankly, is a function of doing so many meetings, answering emails all day, or doing an hour long meeting. I think it's a matter of giving deep thought to what you're doing. And these days, I think insight and innovation is more important than just pure hard work. I think there's enough capital available in the world, but uh, what's not so abundantly available is this aspect of how do we innovate and create a better world? How do we put capital to a better use? And that can only come from good ideas, and good ideas are a function of attention. And you can't be attentive if you're just busy your entire week, the entire day.
and for you, there are meaning no phone calls on your work days before 4 p.m. No Slack, no opening of
Yeah.
emails,
Yeah.
nothing.
In fact, I mean, the phone calls are also, I mean, disabled. I've done this. iPhone has a great feature of silent unknown callers. So I don't even pick calls if they're coming from unknown people. So I think until 3 or 4 p.m., it's just me and reading on my laptop, writing an essay, or composing a Twitter thread and really thinking deeply, or maybe even writing a document on an aspect of Wingify. But it's just me. I don't like Slack, WhatsApp, phone before 4 or 5 p.m.
And if I can ask, when is the book coming out? I love all the chapters which you have posted. Uh,
Yeah. So it's actually written. I mean, I had written all the chapters, but I'm releasing it one by one after reviewing it, making better looking diagrams. So I'm keeping up. I mean, it's also, I mean, I believe that if you are enjoying something, you do it as slow as possible. So I'm sort of intentionally delaying it because I'm enjoying this whole process so much. So uh, one post per week means I think it should probably be done by this year sometime.
and you have a physical book deal in place right now for it.
No,
It's
I feel putting it online. I was reading. I think a median book is sold 10 or 20 copies. So I think physical book is more to stroke the ego. That is the one I wanted that, but I think the chapters of a book have been read by more people already than what my book would have been. Likely to have sold in number of copies. So I'm happy to just put it all online and people could read there forever for free.
and I especially love the diagrams in the book. I think that's done by a wife.
Yeah, the initial ones were they're really beautifully done, and then she got just sick of me requesting all the time to draw, and then I went to degrade the quality, and now I create them myself. But the initial ones are by her, and they're gorgeous.
Thank you so much, Paras. It's been a wonderful conversation exploring your mind on money and wealth.
Thanks, Siddharth. Really enjoyed talking to you.